Hello everyone. Welcome to this another webinar on Friday evening. Today we have a special guest, Mr. Devinjit Singh, who is founder and managing partner with Xponentia Capital. A lot is happening in the listed space of equity markets. Especially in our last year, 2022, we have seen markets have gone through very decent correction. And as 2023 has started, a lot of correction is happening again, ahead of us. So we are not here going to talk anything about listed space. We being, PM IST World Platform represent alternates. And as 2023 began, we had actually this year thought that we will bring a lot more beyond listed space for our clients, for our audience, because in the space of alternates there's a lot of innovation that's happening, and there are definitely a lot of new fund managers who are coming up, but it's important to select the right ones which bring with them good amount of experience, wisdom, and that discovery continues and goes on. And that is how we have been doing webinars on every Friday. And I proudly introduce you to Mr. Devinjit Singh, who is our guest today. And he represents unlisted space of investments, and he brings with him more than 3 decades of experience. He would like to introduce himself in detail, while he'll be giving his introduction as well as detailed presentation about the entire thought process and approach that he and his team has been following up in ultimately creating a lot of value while discovering and making investments at a mid stage of a company, which we popularly known as a private equity, in private equity stage of investments. So not taking much time, I'll hand it over to Mr. Devinjit Singh for him to begin and kind of, start with the presentation. In the second half of this webinar, we'll be doing Q&A. So while Devinjit Singh will be, talking about creating value through corporatization of mid-market businesses as a topic on, this webinar, you guys can ask as much questions as you want. You can maybe type that in the chat box. I will ultimately take, most of them. We'll try to take most of them in the second half. Over to you, Devinjit, for this presentation.
Thank you, Kamal, and good evening, everyone. Thank you for joining this webinar. I'll start with a quick introduction about myself and my background, and also Xponentia. We are very active in the private, unlisted mid-market investing space. And it's an area of interest to investors because not a lot of investors have exposure to this category of the Indian economy. We think that there are a lot of gems, in the Indian economy. When you look at the overall economy, there's about 5,000-6,000 listed companies. But 40-45% of India's GDP actually is mid-market businesses, which are in the unlisted space. Within this space, there are, like I said, there are a lot of gems. There are a lot of ways to create value. Between my partner and me, we've been working in this space for more than 20 years, 25 years, doing only unlisted private investing. And we think over the years, we've generated good returns. And there are ways in which you can actually create value in this segment through what we call corporatization of these businesses, which is really the theme that I will focus on. Just starting with my own introduction, we started Xponentia Capital Partners in 2018. So we've been active now for about close to 5 years. Prior to this, I've been in the industry for more than 3 decades. I spent 20 years of my career with Citibank. And of my initial career with Citibank, I used to run Citibank's mergers and acquisitions business till 2008, when I left to join Carlyle. Carlyle is the second largest private equity firm in the world, one of the most pedigreed and premier names in the industry, one of the founding firms of the industry actually globally, manages now about more than $400 billion. I set up Carlyle's practice in India and led that practice between 2008 to 2018. Invested close to $1 billion on behalf of Carlyle, and a lot of those investments were quite successful. And that's when I thought of starting Xponentia, for domestic investors, some of whom would be on this call as well, and to give them an opportunity to experience the same sort of returns that Carlyle has delivered over many years. And that's what we are looking to do in Xponentia. Between me and my partner, we have been in this industry for like I said, about 20-25 years. We've invested about 10,000 crores in the mid-market unlisted space over our investing careers. And when we left our respective firms, that 10,000 crores was worth about 30,000 crores. So we've generated returns for investors across multiple cycles. And I think that's very important in investing, to be able to, make money across cycles, because what you do now is very different from what you did, we did 5 years back, very different from what we did, 10 years back. So investment themes keep changing. And one of the key, requirements, or one of the key success factors for an investment manager is to continuously, reinvent, unlearn, and relearn, what the new opportunities are. Some of the investments we've been involved with are, some of the fairly marquee names, which are on this slide. These were actually all mid-market companies at some stage of their evolution, which is when we had actually invested in them and generated obviously good returns, for investors through these investments. A quick word about Xponentia in terms of what the business is. We raised our first fund in 2019. We are ranked as a top quartile category 2 fund by CRISIL based on every metric that CRISIL has. We're probably, if there was a top decile, we would probably be top decile. We're now raising our second fund, which is much larger than the first fund we raised based on the performance of Fund 1. We've seen very good investor interest, and the fund size is about 750 crores. We've already raised about 650 crores, and we think we'll certainly exceed the fund size based on the investment interest that we're seeing. The guiding principle of the fund, and I'll come to this when we speak about also the value creation thesis for how you make money in mid-market investing, is this guiding principle of what we run the fund with, what we call to make 3 to 5 times money in 3 to 5 years. And this is how we run the fund, and we think this is the right way to play the mid-market investing game. This is not a game where you look for, or you should look for 10 baggers, 20 baggers. That's not the game here. A lot of the venture investing in the private side has that sort of approach. So when we look at our fund as well, we don't look for creation of unicorns from the fund. We don't look for like I said, 10 baggers, 20 baggers. We think it's important to build what we call margin of safety in investing, and that's we think a requirement when you look at investing in the mid market in the unlisted space, to have enough margin of safety. And it's okay to give up 10x returns, and if investment does make 10x, it's okay to make 8x, but increase certainty to make 3 to 5 times your money. So we try and work with this philosophy, and this philosophy we think can generate 25 to 35% type returns, and that's what we have delivered over the last 20-25 years of investing that we've been involved with in the Indian market. This is how Fund 1 had actually played out, and I'm just going to quickly skim through this slide. Fund 1 was a 350 crore fund. We've actually invested only about 320 crores as yet, and returned the entire capital of the fund to investors. So investors have got all their money back, which is a distribution ratio of 100%, close to 100%, which is quite unique in the private investing market. The IRRs are tracking quite attractively, and I keep telling investors that not to be guided by what is currently being delivered, but over time we think 25 to 35% returns are really what is more sustainable. Obviously Fund 1 has sort of exceeded that sort of metric. So why do we think why invest in the mid market or unlisted space at all, right? So let's start with a basic question there. And if you look at the Indian market, one of our beliefs is that there are pockets where there is a lot of liquidity and there's a lot of money. And equally, there are a lot of pockets where there is no money and there's no liquidity in India. So if you look at this chart, you have on the x-axis, you have early stage companies, and you have mid stage companies, and you have later stage companies, and as you go on, companies IPO and become larger. And on the y-axis, you have deal size, which is basically the requirement of capital keeps increasing as the company size also keeps increasing. So if you look at the top right of this chart, which is where the scaled up, or call it single A, double A, triple A companies would be there. They have access to multiple avenues of capital. They have access to debt capital. They have access to public markets. They have access to the Carlyle, KKR, Blackstone, TPG. There are multiple funds, active in this space. So when I was at Carlyle as well for 10 years, most of the companies we used to meet used to be what we call fully baked companies. They are fully, evolved in their level of governance. They have management teams, they have systems, they have process, so they are in some sense fully baked businesses. And a lot of capital looking to come into India, a lot of domestic capital in the public markets, all very and you've seen the public markets in India as well, they reasonably awash with liquidity, and valuations, one can argue, fairly full in spite of the recent correction, which Kamal spoke about. Move to the bottom left of this chart, and this is where the early stage, or the startup ecosystem, or and we've seen a lot of activity here in the last 4 or 5 years. A lot of unicorns have got made, and this is what I call the unicorn market. This is going through, what is now popularly being known as the funding winter, and I think some of that is just the excess of the excessive heat over the summer, being followed by now the funding winter. And I think this segment of the market is certainly going through a lot of pain, as we see valuations, including some of the listed stocks, have corrected quite substantially, which have been new consumer tech companies and, largely the new economy space. But if you look at the mid market in India, which is what I said, roughly 40-45% of India's GDP, these companies still struggle to get loans from banks. They still borrow money at 12, 14, 15%. They're required to give, margin money, promoter guarantees, collateral, takes 6 months, 9 months to get a loan. And in spite of that, there's hardly adequate funding available from the debt side, and almost negligible funding available on the equity side. There are hardly any providers of equity to mid-market companies, which can be, like I said, companies which are 50 to 500 crores in revenues. They are profitable, they are growing, they have good return on capital, they have decent management teams, and hardly any attention given to this segment of the market. So this was the whole basis that we started Xponentia. When we did, when I left Carlyle and started Xponentia, was that this segment of the market is totally neglected. And as the previous slide has shown, there is good returns that can be made by investing in this segment of the market. So there is, proof of pudding that is amply available here on how money can be made, as we've shown with the first fund, because a lot of it, and just to give you the characteristics of this market, is one, like I said, there is a severe lack of capital here, because even for banks today, and we see this with our portfolio companies, even SBI, is asking for single A credit ratings from companies before they give a loan. I mean, it's really quite staggering for SBI to be asking for single A ratings, before they approve loans. There's a good opportunity to do bilateral, investments here, because there is also limited seller sophistication. The the people running these companies don't have the sophistication to appoint a quota or a banker to be able to run a full sale process with a data room, because they just don't have that level of sophistication. The third is that you have the ability to actually acquire substantial stakes and get a seat at the table. So in terms of decision making or in terms of governance rights, you can get a seat at the table and make and exercise reasonable control with these businesses. The fourth is that there are also a lot of structuring possible, and going back to sort of my initial comment on making 3 to 5 times money, there's a lot of ways to protect downside, a lot of risk mitigation strategies, a lot of risk mitigation techniques, which we have sort of learned over the years, which are possible because, these are bilateral transactions. You can actually structure investments in the way that, makes sense. And lastly is, the whole journey of what we call corporatization. And I'll spend, a lot of time on this in terms of, when you look at a typical mid-market company, typically, there are so many good companies run by good entrepreneurs who know their business, who know the industry, who are building good businesses. They are, built these businesses. These are profitable. They are passionate about the business. Most companies have, these characteristics that, I will go through on this slide. And some of the entrepreneurs also, they're good in certain things. So some entrepreneurs we invest in are very good with finance. Some of them don't understand finance. Some of them are very good with IT, and some of them don't, not so good with IT. I think if you look at a typical mid-market company, and like I said, call it 50 to 500 crores of revenues, profitable, growing, in its space. Typically, the corporate governance structure will largely be family or friends on the board. There'll be no independent directors. You'll have local auditors, typically, for a business like this. The finance and MIS function will be fairly rudimentary. Accounting will be on tally. There'll be no internal audit function. Controls can be fairly weak. The IT strategies will still be a lot of work on Excel spreadsheets. Data analytics may not be as strong. Business MIS may not be as strong. There are now ERPs available, which can address a lot of these things. HR, and almost every company that we have invested in, HR is basically payroll. People get paid at the end of the month. That's really what HR does. No sort of well-defined, org chart, roles and responsibilities, ESOPs to be able to attract professionals. Second, third lines of management, could be missing, or there in some companies, but not fully built out. And even when you look at marketing, these are not really companies that have built national brand identities. What does a brand stand for? Sales and marketing are, used interchangeably. There's more sales culture than marketing culture in terms of understanding and building brands. So this is typical profile of, and like I said, some companies are good in some things, some companies may not be good in some things, but typically we find these as what we call, gaps. And the whole journey of corporatization, or the whole corporatization journey that after we invest, we think that creates value. And this is true for, good times in the economy. This is true for bad times in the economy. This is true for good times in the markets. This is true for bad times in the markets. This creates value. So if you're able to, improve the corporate governance structure of the business, create a board committee managed, a decision-making framework rather than just the promoters, deciding over dinner, what to do with the business. Create a sort of a digital backbone, create an ERP, strategy for the business, create a, e-commerce or go-to-market strategy for the business, upgrade the finance and MIS function to, being ready for even a, Big Four audit, being ready for, internal controls, to prevent frauds as the business scales up. Because if the business is going to aspire to go from 150, 200, crores to 1,000 crore business, if it doesn't do some of these things, then the chances of success anyway are diminished. Because these are actually almost requirements or building blocks for what takes to build a business. The HR practices are fairly, to get them up to speed, and this probably takes the longest time. Because it takes 2-3 years to change culture, to be able to, create org charts, to create KRAs, to create ESOPs, build that second line of, management, and create a brand identity. So what we do here is we work with functional specialists who are specialists in the area of finance, IT, HR, and marketing. We've actually added the marketing, operating partner is what they are called. Based on feedback that we got from our portfolio companies, that this is another area which they see a gap. They understand, local marketing, they understand, online marketing or, tactical marketing, but, how do you think about a brand? So Thomas, who's our sort of HR marketing, advisor, has, been with an advertising agency for about 30 years. Prashant is, been with Accenture, with McKinsey and Deloitte, and, runs an HR firm, a consulting firm. Venkat has been in the IT industry for, more than 30 years. And so is Akshay, who's our finance, operating advisor. And what we have seen is over the last 4 or 5 years that we have been active, as Xponentia, that there is a very high degree of receptivity among entrepreneurs to adopt, to be able to improve their businesses, to create value through the corporatization of their own business. And, like I said, we have case study after case study now available on the tangible changes that, these companies have made, after our investment, to be able to become better businesses, to become more hygienic businesses, to become, more robust businesses. And so there are some examples on, on this slide. So somewhere, SAP has been implemented. Sorry, can you hear me?
Yes, continue. We can hear you.
So there are cases where SAP has been implemented. There are cases where a local auditor has been transitioned to EY or a BDO. There are cases where from no HR department to actually hiring of an HR person to creating an org structure with incentives, KPIs, full organizational plan for the next few years. So case study after case study actually is now available, and the whole logic is that when you invest in businesses like this, you get dual levers of return. So you get earnings growth, because companies at this scale are still able to grow 20, 25, 30% based on revenue and earnings, because the size of the opportunity is still fairly large. They're still not at a scale where the law of large numbers, it's very difficult to grow at 20, 25% when you're a 1,000 crore business. It's much easier to grow at 20, 25% when you're a 100 crore business, right? So and the second thing it does is that it gives you a multiple expansion from the time you invest to the time you exit, because in the process of corporatization, you have actually created a better, scaled up, more hygienic, clean business, which generates a lot more investor interest or buyer interest if there is, a strategic sale possible at the end of the investment period. So I think the important takeaway here, and like I said, we have enough case studies in Fund 1 to be able to demonstrate this, that the whole journey of investing, you have dual levers of return in addition to earnings and revenue and earnings growth. If you are able to create from what is a half decent company, create a decent company in the 4 or 5 years of the investment period, then at the end of it, in addition to earnings growth from the multiple that you paid, or valuation multiple that you paid going in, to the time you exit, you get a valuation bump up. You get a higher multiple because you have now created a larger scaled up business with some of the things that I spoke about. I'll just end with a case study of an example of a company that we had invested in, and how this created value over the life of our investment. So this is a company we invested in, which is an express logistics company called Spot On Logistics. We invested in 2018. This was our first investment, actually. The company did what is the mid-mile of logistics. So, logistics has very different parts of a value chain. There is warehousing, there is transportation, there is customs, there is, there's B2B express, there is B2C express. So B2C express is, for example, like what Delivery and ShipRocket and Express Bees and all do. This company would, take goods from, say, Amazon's vendor and deliver it to Amazon's depot, but not do the last mile. And as a result of that, this is our take, goods from Bosch's, factory and deliver it to all of Bosch's dealers across the country. So B2B business, it was basically 450 crores of revenue, 36 crores of EBITDA. The company made 35% return on capital. It was growing at 30-40%, when we invested. And most of the companies in our portfolio, in fact, with one exception, every company is profit making and cash flow generative. We grew the business, we corporatized the business, along the lines that I spoke to you about. Business revenues grew, from at a CAGR of 26%. EBITDA grew from 36 crore to about 70 crores. We recalibrated the business from, strengthen the overall network, created a high margin SME and retail business within the business. We also made an acquisition during the time of our investment. We added a 3PL logistics business. And then last year, ahead of the IPO, Delivery, which is now listed, they were doing the last mile, and the mid mile was a gap for them. So they made us an offer to buy the business. And we sold the business at a 3 times money multiple within 3 years, generating almost IRRs of about 70%. Between our time of investment and time of sale. So, one of the very successful case studies, and, quite typical of the kind of portfolio that we've created. So I'll pause there and open up for questions.
So I think, the presentation has been quite insightful. So the foremost question, which I can think of after going through this presentation is, first, let me understand in the current context, from investor's point of view, how should he decide whether he should be investing in the listed space or an unlisted space? If you put yourself in investor's shoe, how would you approach this particular aspect?
I think it's a great question because I think the Indian economy is at a stage of evolution where private investing is just about starting. So how to allocate, or asset allocation, is, I think, a very, very important question. So let me give you what the thesis behind private investing is. Okay. So every investor has a corpus of, call it 1,000 rupees, right? For example, within that, they will allocate to debt, they will allocate to equity, based on their own, risk profile, based on their stage of their, what their age is, what their risk profile is, all of that, right? Now, within the category of equity investing, the only opportunity that investors have had hitherto is largely been the public markets. And the public markets, have generated, call it 12, 13, 14% return over extended periods of time. And, they should deliver, call it 4 to 5 percentage premium points to debt returns. Now, there is a core surplus which each investor has. So if you, out of the 1,000 rupees, there's probably 100 rupees, which you probably, of 150 rupees or 200 rupees, which you probably don't need for a period of time, right? And the whole thesis of private investing is that you invest in a private equity fund like Xponentia, and you're willing to give up liquidity for 3, 4, 5 years in exchange for a higher return, because you don't really need that money. You're willing to put that money away. So most global investors, whether it's family offices, whether it's institutions, whether it's HNIs, allocate between 10 to 20% of their corpus to alternative assets like private equity. And the whole thesis is that out of my 1,000 rupees that I have, I don't really need 100, 150 rupees for the next 5, 7 years. I'm not going to really touch this money. I don't need the liquidity, and I'm willing to play the long game. And in return for this, I should get a 5 to 10 percentage premium points premium to the public markets. That's what the asset class exists for. The asset class has delivered, and that's why it's such a growing asset class even globally. So, when I joined Carlyle in 2008, Carlyle managed about $150 billion. When I left, it was managing about $400 billion. That's the sort of scale of growth the industry has had globally. In India as well, the AIF, industry has grown at a rapid pace over the last, 5 years or so. And the reason I call it evolution is also because in the past, there were also not enough good quality managers with experienced track records who had actually, were managing funds in India. Investors in India couldn't invest in a Carlyle or a KKR or a Blackstone, right, because of currency control. So rupee capital has to be managed by, rupee managers like us. And that was the thesis to actually start Xponentia, because this is currently a gap in investor portfolios. Investors have debt of, and there are now various debt products in investor portfolios, and they have public equity. But there is very few managers in between who can provide this alpha, call it, return to public markets for that core part of your portfolio, whether it's 5%, whether it's 10%, whether it's 20%, that an investor doesn't need over a period of time. And that's where the logic of private equity is that an investor gives up liquidity in exchange for a higher return. And typically, like I said, the industry works with 5 to 10 percentage points premium to public markets.
So, one is the liquidity risk that investor is taking by investing in unlisted space. But apart from this, obviously there are other risks as well. So would you want to discuss, some of these other risks, and obviously how do you try to contain those other risks so that the risk-adjusted return kind of looks attractive? And then obviously I'm sure some accidents do happen. If you want to explain with some examples, that will also be a good idea.
So I think, look, at the end of the day, there are two elements to private investing. The first element is, just like in public investing, you have to find a good company, you have to find a good management, you have to find a good business, right? That's the first element to it. Additionally, private investing, overlays an element of structuring, which allows you to structure an investment where you can introduce some of the risk mitigation strategies which are possible here. So what are the risks, right? The risks are, these are companies which are not what I call fully baked, right? So they're not as fully baked. Their systems may not be as strong. Their financial audit procedures may not be as strong. The management team may not be as strong. So they are not as scaled up as listed companies. So by definition, the mid-market businesses are, like I said, they're smaller in size, and their systems and processes, may not be as scaled up as listed companies. So that is, I think, the first risk. The second risk, like I said, is similar to public markets, where just like a company's profits and sales can increase or may not increase at the same pace as you expect. The third, and this is probably the most important, is the loss of liquidity. Is in the public market, when you need the money or you don't like a stock, you can exit and 24, 48 hours, or at least maximum in a week, you can get your money. The art and science of private investing is all in the exit. It's easy to invest. It is harder to create value from the investment, and hardest to find an exit from the investment. And I think that is something that we at Xponentia have, the one thing apart from, the returns, in fact, more than returns, that we feel most proud about is within 3 years, we've actually returned 100% of the capital for our investors. And now they're just riding profits, right? So it's a investing strategy. And I've seen a lot of family offices in the last 2, 3, 4, 5 years doing a lot of direct investing into private companies without fully understanding the implications, and some of that worries me. So this is a type of investing where you need investors who can understand the implications. These companies need monitoring. You cannot wait for quarterly numbers to come out and then go and find out what the results are. You need to be in and out of these companies on a monthly basis. You need to be engaged investors. You need to be under the hood or under the skin of these companies, which is what we do. So at any given point of time, we make 3 to 4 such investments in a year. In any fund, there are 10 to 12 investments. That's the maximum that we can handle from a management bandwidth point of view. So these are high engagement, high involvement investments. There are good companies, good management teams, but yes, equally, you need to be able to manage risks. You need to be able to structure the investment to mitigate risks. And that's really quite key. And most importantly, focus on being able to generate exit liquidity is very, very key in this business.
Sure, Devinjit. So, another question which investors would like to understand is that with regards to your first fund, which was started in 2019, you have already shown track record and some of the investments those were done. But apart from that, the second fund for which you are raising money at the moment,
Yes.
are there any examples that you want to take, type of business model or companies with which you have signed up some deals, or
Yeah.
the kind of companies you're expecting to sign up? Because obviously, your discovery for next 5 years in this series two of your fund would also depend upon your view about the macro analysis and maybe some kind of sectors. So what is the thought process? What is the kind of business model? Then how will you ultimately approach building of this portfolio?
Yeah. So let me give you an example of a company that we are signing up in. You see the screen?
Yes, absolutely.
So this is a example of the kinds of companies that we look to invest in. This company is in a sector that we like, which is insurance. In the insurance sector, we think the insurance sector should grow, between 12 to 15% over the next 2 decades. And within that, the insurance broking industry should grow, even faster, and the leaders should grow, at even a faster pace. So this company is in the B2B insurance broking space. They provide insurance broking, not underwriting. So they don't take risk to small and mid-sized and some large-sized businesses as well. The business this year will do revenue of about 200 crores, EBITDA of about 60 crores. And if you see the financial metrics, it's been growing at about 30-40% every year. Very profitable. Return on equity of about 30-35%, growth of about 40-45%. So these are the kind of companies that I would call in the category of the gems that I spoke about.
So how do you discover some of these companies? Is there a process, whereby some of these companies who are wanting to raise money, they come to you,
That's
or
right.
you reach out to them by way of some pipeline in place? What is the
Yeah.
process? How does this happen?
So it's actually both. Just give me a minute. It's actually both. So, we invest in four sectors, largely the whole consumption story of India. So we don't invest in real estate. We don't invest in infrastructure. We don't invest in commodities. We don't invest in the hard assets. Largely the consumption story of India. So consumer products, healthcare, financial services, and business services. What we call, for example, logistics. So these are the four sectors that we invest. Within these, we actually take a micro sector approach to investing. So, for example, we studied insurance. We liked the overall dynamics. And within that, there's insurance manufacturing, there is insurance broking, there is, there's B2B, there is B2C. We studied all of these and then decided that B2B insurance is a segment that we like. There are no listed companies in this space. We went out, there are very large global companies in this space. We went out and met, every sort of large company in this space. There was an investment opportunity here. And, it takes us 6 months, 12 months to actually find and, make an investment. That's how the investment methodology and process is. To give you a sense, we make 3 to 4 investments a year on average. The inbound approach that we see is 4 to 5 investment opportunities a day. That is the level of requirement of capital in this segment of the market.
Sure. So another question, that I think investors would have on their mind, and I can kind of see from the chat. So if an investor is able to identify a couple of options, like you have a diversified fund in the private equity space, there are other funds in the space who are who call themselves themselves as deep tech funds, and maybe there could be a fund which is focused on EV as upcoming opportunity. So a lot of these funds have come in the past and they have raised money. Some of them are still raising money. So amongst your own category, within category two, there are 3, 4 very credible names. if investor, is faced with this choice, obviously, he has to select one.
Yes.
There could be family offices who can put money in all of them and maybe, have a larger pool. But if I was one investor, I will have to select one. So what are the cues? What are the kind of, I would say certain strengths that you would want to talk about
Yeah.
for an investor to
So,
look to kind of.
I think, again, a great question. And the industry, like you said, there is has raised a lot of money. And I think this has also, the regulator has also been, very proactive, or SEBI has been very proactive on this. Can you see the screen?
Yes, I can see the screen.
So, just like there is a ranking or a benchmark created on the public side. So 2 years back, SEBI has now mandated for all AIFs to provide data on an apples to apples basis to CRISIL. And CRISIL has created a benchmarking index. And they issue this once every 6 months. Twice a year they issue this, because it's not a daily NAV sort of business. So twice a year they issue this, in March and in September. They issue this report which ranks funds based on the IRR, which is the obvious, but also distributions and total return, which are the three sort of key metrics that that investors should care about. And they also rank them by top quartile, second quartile, third quartile, fourth quartile. They issue a ranking. So I would urge investors to, whenever they are evaluating a fund, to, request this. This is now mandatory by SEBI. We also participated and participate in it. And like I said, SEBI has mandated this for all AIFs. Basis this, if you're to sort of use this, benchmarking, we've been a top quartile fund on almost every metric that CRISIL tracks. But that's a great question, and I think what SEBI has done and what CRISIL have done actually is just fantastic for the industry to be able to create transparency for investors.
Right. So thank you. This is quite insightful. I think this, way of comparing funds will be a good idea before making the final investment decision. Another question, which somebody has asked in the chat box, I think is a pertinent question to understand. Over your, career as a fund manager in this space over say last 4.5 5 years, when you have been managing money in your series one of Xponentia's private equity fund, uh, you have talked about very high returns that your fund has delivered so far. But are there any examples of any mishaps or any companies which have gone wrong? And
Yeah.
then what are the learnings that you think you have had? And were there just by chance, or it was because of COVID, or were you able to control that in time, or it just went on and the entire capital got lost? So kindly give us those examples
Sure.
also.
So again, great question. So I think, look, investing is about trying to see as much as you can into the future. So not everything goes to plan. We try and mitigate a lot of unexpected events through some of the structuring that we do. And how we do the structuring is actually part of a much longer discussion. But let me give you some examples of things that have gone wrong. One is a company that we invested in, which is a pilot training business. It is India's only approved trainer for Boeing and Airbus pilots. It's about a 10-year-old company. When we invested in it, it was doing about 80 crores of revenues and about 35 crores of EBITDA. So very high margin, profitable business. In 2 years, we invested in 2018. In 2 years, the EBITDA expanded to about 80 crores. A company was just doing very, very well. And then COVID happened. And as everyone knows, COVID was very hard on the airline sector. But thankfully, this company, didn't do as badly as an airline did, because pilots still kept coming to us for training because they needed to keep their licenses current. So our EBITDA dropped from about 80 crores to about 50 crores. And this year, of course, it's been their best year, and the EBITDA will cross about 100 crores is what the company is tracking to. But we're quite pleased that for a company that has in the airline sector, which has gone through COVID, we've managed to grow EBITDA from about 35 crores to about 100 crores in the 4 years that we've been invested in this business. So that was a sort of an environmental thing that we had to navigate through. The second mishap that we've had is a diagnostics company that we have invested in. This company was doing about 150 crores of revenues, about 30 crores of EBITDA, 50% return on capital, and growing at about 20-25%. We invested just on the back of COVID, and this year the entire diagnostic industry has not grown, because there was a lot of testing, apart from just COVID tests. There was a lot of testing in the industry that everybody in the country was doing, just because healthcare concerns were very high. So this year, the diagnostic industry itself, has just not grown, including all of the listed companies, which has come as a surprise to us. So we have lost 1 year of growth, in that business, which we did not expect. The company is still generating cash. It is still throwing up cash, but we thought it'll go 25-30%. It's grown 3, 4, 5%. To answer your question on again mishaps, the way we structure the fund is that we are not looking for 10 baggers, and we don't like to lose capital on investments. So we don't think we will lose capital on any single investment in Fund 1. What return it generates, obviously, may vary, but we don't think we will lose capital on any investment.
Sure. So while making an investment, you are more concerned about investment being in the money. You are not too much greedy about it coming out as a unicorn or a multi-bagger.
Absolutely right.
At the same time, there are many new disrupting businesses, like platform businesses across industries, that must be coming in as an opportunities to you. How would you kind of restrict yourself when sitting on so much fund as a value, and obviously you have to compete with your other funds in the industry who are going to invest in EV space or going to invest in deep tech space, and you have to continue to come up as a number one fund. That is, I'm sure, as a fund manager, you will have that ambition. And that is where you have to balance between not going wrong and at the same time generating alpha, which is a very difficult task, especially in the mid stage, because the portfolio is going to be concentrated. So how will you ultimately practically handle this situation in future? Last 4 or 5 years, your first fund may have been a good luck or a chance, right? But obviously with 30 years of experience, I expect you to kind of let us know if any such things happened in the past. How did you control greed as well as fear, and made all these wise decisions, and kind of will continue to do that even in the second fund?
Yeah. So again, great question. Look, investing is all about, like I said earlier, it's about trying to stay one step ahead of the curve, right? So, what made you returns in the last 5 years not going to make you returns in the next 5 years, right? Otherwise, investing would be very simple. So as a manager, and which is why I said at the top of the discussion that you need to have made money through multiple cycles. There are business cycles, there are economic cycles, there are interest rate cycles, there are and within sectors there are cycles, sub cycles as well. So you have to keep learning new things. You have to keep unlearning old paradigms, and that's, I think, quite key to. So we absolutely, I think in between 2018 and now, since we've been with Xponentia, obviously the pandemic has been a huge event. So almost like a pre-pandemic. There's pre-pandemic world and a post-pandemic world. And the reason I say that is because I think the whole digitization process and the pace of disruption that we are seeing right now is probably something we have not seen for many years. A lot of e-commerce or payments or all of that 5-7 years of growth has got crashed into 12-18 months. So we've also had to pivot. And some of the investments we have done in the last 1 year, frankly, if you had asked me in 2018 whether we would do those, the answer would have been no. So to give you an example, we've invested in a D2C, a digital baby products business, which was doing about 5-6 crores a month, of 3-4-year-old business doing about 5-6 crores a month when we invested, about 60 crore sort of business. They make prams and cots and strollers and car seats and tricycles for babies. India produces 2 crore babies a year, and there is no baby brand actually and there's no local baby brand in the country. We invested in this company. It was run by a bootstrapped entrepreneur who was still making not burning investor money, or he had no investor money, spending his own money and making 2-3 crores of meager profits. We invested in this company. They have now launched diapers. They have launched, wipes and creams and lotions and, full range of baby products. 90% of their business is online. And, would this kind of adoption, when we invested, like I said, about 18 months back, the business was doing about 5-6 crores a month. In Jan, they've done about 12 crores a month. That's a pace of growth. Would this kind of growth have been possible pre-pandemic? Probably not. So, we've had to also pivot. Digital brands are now getting created. 10 years back, to create a consumer brand in India, you would have had to fight a Unilever. You would have had to fight, to get onto the shelf. You would have distribution would have been hard. The whole distribution paradigm has got changed, right? The internet has unlimited shelf space. So that adoption has changed so much. You spoke about EVs. So we have a EV investment. And again, as investors, you have to keep, I'm going to, let me put this slide up. So for fund two, the way we do this is that, most of our investments in 1,000 crore fund, will be about 100 crores or 10% of the fund. We do about 8-10 investments of, roughly 10% of the fund. But we also keep a corpus, okay, for new age and disruptive businesses, like the EV business, which we have an investment in. But we will risk only 3-4% of the fund in each investment for these kinds of investments, and a maximum of about 15-20% of the portfolio.
Right, Devinjit. So I think we are coming to the end of this webinar. So a few more technical questions. You talked about that, in the very first question, one of the reasons for one to invest in unlisted space of category 2 versus listed space is, getting higher return for a risk of illiquidity.
Right.
Now, you also quoted that higher return could be, you can say 5 to 7 to 10%. As a expectation over and above a listed space, right? Now, how much is this extra return that gets delivered in this unlisted space taken away by way of maybe additional taxation or additional charges? Because to ultimately investor, what matters is net of expenses and net of charges.
So 2 parts to your question there, and I think it's a really really good question. I'm going to just go back to the. So if you look at the returns here, there is a gross return and there is a net return. The gross return is what the portfolio generates, and the net return is what the investor makes, what is net to the investor after all fees and incentives and carried interest and additional return. And I think it's very important for a manager to be able to manage the fund, and there are techniques and strategies which we have adopted for fund one to minimize the friction between gross and net return. I think in the case of our fund, the delta between gross and net return will be among the tightest among any funds. So this is a subject of a longer discussion on how you can potentially minimize the drag of fees and incentives for the investor. There are ways to do it. We think we have done a pretty good job with doing that, and we are one of the few funds that actually reports net return to investor in all our reporting. So what the investor cares about is the net return that the investor makes, not the gross return that the fund makes. Coming to tax, the tax treatment of these is the entity is a pass-through like any other AIF, and the taxation is in the hands of the investor. So for unlisted securities, which is for the most part what we do, the exit, if it is on an unlisted basis, it's 20% with indexation, so works out about maybe 12-13%. And that's a sort of, if we sell into an IPO, which is the case with Barbecue Nation when we IPO'd the business, then it's similar to listed equity. So that's where the current status is on the taxation aspect.
Sure, Devinjit. I think this pretty much brings us to the end. To the audience, I would like to state that amongst various other options available in this category, we have specifically selected, shortlisted this particular fund and fund manager and the entire team after evaluating across quality, risk, and consistency, the QRC framework that we generally follow. There could be a lot of other questions that may not have been answered in this forum. I would urge all of you to maybe come to our website PMSAIF World and book your appointment with our specialists for us to be able to handle your unique questions, because investing is a very unique requirement for every investor. Every investor may not be sitting in the same situation. Your current portfolio, your investment goals and time horizon, as well as your risk profile, your attitude, a lot of other factors determine the suitability of an investment for yourself, and we are quite experienced in handling all such queries. So thank you everyone for joining us on this webinar on this Friday, and thank you Devinjit for sparing your precious time. It has been very insightful discussing about the unlisted space and the way you have been approaching this space. Many good wishes to you for your fund, and look forward to more of such interactions, more of such forums. I think your another co-founder is participating and joining us in our upcoming event, which is on 10th and 11th of February, Crystal Gazing Summit that we have organized. It's our 4th annual summit, and my welcome to all the audience here to that summit as well. We have been circulating a lot of emails as well as messages amongst our participants. There have been more than 2,300 registrations already. Look forward to again hearing about this concept on unlisted space investing in that particular panel that we have kind of organized, and I think for 10th of February around 4 o'clock. Thank you so much everyone once again. Have a nice weekend.
Thank you.